Hello, everybody. I'm going to wait just a minute, as usual, for people to come into the webinar, and then we will get started. Hope everyone's having a good day and trying to stay cool. At least we have some cloud coverage today. So per the normal format, what we will do is go through the presentation, silver linings of this bear market, and then we'll kind of open the webinar to Q&A, which we'll try to leave the last 5 to 10 minutes for. This will be about a 45-minute webinar, I expect. Both Jeff and I are on the webinar, and we're really excited to be hosting this. And just to start, I think it's important to say we're not trying to diminish or dismiss some of the challenges that are facing the market and the economy, but you can find those challenges and any number of reasons to be pessimistic by turning on the news or by picking up a newspaper. So the point of this webinar is to try to provide some balance and some of the positives that are emerging as a result of the bear market. Just to start from a technical issue standpoint, housekeeping, if you could type into the chat box that you can see my face, see the screen, and hear my voice, I would really appreciate it, and then we can get started. The chat box should be at the bottom of your screen. You can click on it. And then you can just type in hi or raise your hand. That's fine. Thank you. Okay, great. Thank you very much. So it sounds like we're in good shape. This is definitely one of the more popular webinar topics we've seen in a while. So I'm glad to provide, or that we can provide some relief in terms of some of the silver linings that we see. All right, so let's go ahead and get started. First, we have to read the disclaimer, since we do mention some individual securities here. So 4J Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where 4J Wealth Management and its representatives are properly licensed or exempt from licensure. This content is solely for informational purposes. Past performance is not a guarantee of future returns. Any securities mentioned in this webinar do not constitute a solicitation to buy or sell. 4J Wealth may own securities mentioned in this webinar. Investing involves risk and possible loss of principal. No advice may be rendered by 4J Wealth Management unless a client service agreement is in place. Okay, let's go ahead and get started. So, cost of living increases on retirement income. So this is looking at the cost of living increases that Social Security recipients have received going back to 1975. As you can see, in 2022, there was a 5.9% increase for Social Security beneficiaries, which was the largest increase going all the way back to the early 80s. And it looks like in 23, there's going to be another very material increase. If there's no further inflation this year, you can see that red line in 23 would be the increase, which would be north of 7%, almost 8%, and all the way up to potentially 10.8% if inflation continues to rise at its current pace. And remember, whether you have started Social Security or not, this is still, you would still benefit from this cost of living increase when you eventually do collect Social Security. So, not many people in retirement have income, or a small portion of their income is linked to inflation, linked to the price of goods and services going up, and Social Security is one of those income sources. So I think this is a really big positive for people in retirement. They're finally getting a material increase in their income, and this is going to be the case also for FERS pensions, CSRS pensions, and military pensions. Right? It might not be quite this high, but it's going to be material. So that's definitely a silver lining of what's happening here. On the financial planning side, there are a couple silver linings that we see. One is Roth conversions, and the other is something called tax loss harvesting. So first on Roth conversions, when the market is down, converting money from an IRA, traditional IRA, to a Roth IRA allows for the potentially lower valued positions to recover, right? When the market rallies, eventually, those gains will occur in a tax-free Roth IRA account. So you wouldn't want to just convert for that reason alone. It would want to be evaluated in the context of your income and tax circumstances. But to the extent you're already considering doing Roth IRA conversions, the timing of doing them once we're already in a bear market, in our opinion, is a very attractive time to make those conversions, so that when the positions ultimately do come back, okay, it would occur in a tax-free manner. Secondly, money that you have invested outside of retirement accounts. So think an individual brokerage account, or a joint brokerage account, or a trust brokerage account, where the gains and losses that you incur on an annual basis produce realized long-term or short-term capital gains or losses. You can sell positions that have an embedded loss and harvest those tax losses. And if you're looking to reposition your portfolio, you can sell positions with the tax loss, sell other positions that may have an embedded gain, and those losses can be used to offset that gain. If you don't necessarily want to sell positions with gains, you can still sell positions with losses, and then those losses will be carried forward to future years, where you can then sell positions with gains, and the losses will offset those gains, so you won't have to pay as much in taxes, or potentially anything in taxes on those gains. Okay, onto the economy. There has been a resurgence of onshoring and reshoring of US manufacturing. And COVID, really revealed the fragility of the global supply chain. And as a result, both as a matter of national security and just companies wanting to have redundancy, there's been a dramatic increase in the number of times reshoring, nearshoring, and onshoring have been mentioned in the S&P 500 earnings call transcripts. So you can see here, going back to 2012 and 13, there's some mentions of it, but just a dramatic increase since the start of COVID to the number of times these things have been mentioned. And even foreign direct investment. For example, Taiwan Semiconductor is building a $10+ billion semiconductor manufacturing plant in Arizona. Intel is investing, I believe, $17 billion in a plant in Texas. And there's a number of companies that are doing exactly this, where they're reinvesting to bring manufacturing back to the US or to Canada and Mexico, which is called nearshoring, so that there is less fragility in their supply chain and more redundancy. And this, frankly, could be really a part of the backbone of the next expansion that we have, because we really, from beginning of 2020, when COVID started, to really end of 21, early 22, we had a rapid boom and bust cycle, right, where economic activity contracted and then it went through the roof, and then it's cratered. So we're kind of taking the medicine through higher interest rates now, but if U.S. manufacturing can be competitive and come back to the U.S., that could serve as the backbone for a much more sustained expansion when we eventually come out of this, and that's very exciting. All right, inflation, right? Inflation, you hear about inflation, you feel inflation, you can't avoid it. What's interesting, though, is when you look at the difference between consumer expectations of inflation a year out and 5 years out. And over the next year, consumers are expecting inflation to stay at very elevated levels. You can see here, expected, a year from now to still be at north of 5%. But over 5 years, consumers are not expecting inflation to be as sticky. It's still elevated from the last decade, but at a level of closer to 2.8% versus the 5+% that is expected in a year. And the reason that's important is inflation expectations have a significant role in consumer psychology. And if consumers think that inflation is going to continue to be high for a very, very long time, they're going to accelerate their purchases as much as possible to avoid paying a higher price later. What happens is you get this vicious spiral of inflation going higher and higher. So, we think that this is a silver lining, is that people are starting to see that a lot of this could be temporary, and some of it will certainly be sticky, but not at the levels that we're seeing right now. Sources of bond yields, right? Interest that you can earn in your bank accounts and bonds. What you're looking at here is the yellow diamond is the average yield in various bond asset classes going back to 2009. And the blue bar is the current yield in these various asset classes. And so what you can see across the board, whether it's treasuries, mortgage-backed securities, investment-grade bonds, or high-yield bonds, the yield that can now be obtained, this is a big silver lining of this bear market, the yield that can now be obtained in fixed income is materially higher than what could be obtained over the last 12 years. And you can see here, treasuries alone, right? It's double. So what you can get from the government in terms of a risk-free rate of return on treasuries is double what it has been historically. And that's pretty consistent across the board in terms of the increase in yield. Investment-grade corporate bonds, right? So corporate bonds that have an investment-grade credit rating by Moody's and S&P historically was closer to 3.5%, and now it's pushing almost up to 5%. And high yield significantly higher at 8.2%. So we view this as a silver lining, and the fact that clients and investors can obtain a yield, close to 3 to 4+% in fixed income allows for some clients who don't necessarily need quite as much return to take a lot less risk and still get very attractive return. Historical interest rates. So this is some nice perspective on the 10-year treasury and the 2-year treasury, the yield, okay, that you could get going all the way back to 1960. And you can see kind of starting in the early 80s, a lot of you probably remember mortgages were 14, 15, 16%. You could probably get close to that on your money market. And then we had this, it's called actually a bull market, even though it's declining. So as rates decline, as interest rates decline, bond prices actually go up in value. So it's considered a bull market because rates were kind of in this secular decline over a 40-year period. And there's been some discussion that has that bull market ended. Maybe. Certainly it's looking like it, but we don't know to what extent the bear market in bonds, if you will persist and to what levels. But I think the thing to focus on here and to look at isn't so much that the current interest rate levels are so high in the absolute sense, because they're really not when you look back over any meaningful time period. But what is causing so much concern in the markets and the economy is the rate of increase. So you can see, right, the 2-year was basically almost at 0, and it feels like overnight it's now at north of 3%. And the 10-year, same thing. It's much lower levels during COVID and then really shot up. So the silver lining here is, while the rate of increase has been very rapid, the overall levels continue to be, I think, manageable. Manageable from a debt standpoint, manageable in terms of what the government can pay. So it's something to keep an eye on. But again, it just provides some perspective that while rates have increased dramatically, from a historical perspective, they're not at an absolute level. They're not that high. And then back to inflation. This is looking at inflation rates that are expected over a 5 and a 10-year period. So it's the TIPS break-even inflation. And what you can see is kind of going into 22, this was elevated and volatile, looking back over the last 8 years. And then during the invasion of Ukraine, it really spiked, right? The 5-year inflation expectations went up to slightly north of 3.5%, and the 10-year went up to 3%. But a lot of that kind of initial fear has subsided. It continues to be volatile, but if you think about it, right, 5 years out, inflation being 2.7%, that is materially different, right, than what it was kind of pre-COVID, and certainly what it's been over the last 5-10 years. But it's not double digits either, right? So 2.7% is certainly higher than the Fed's target of 2%, but it doesn't mean that it's not manageable. And so I think it's important to recognize, looking out over the longer term, there's been a lot of volatility in inflation expectations, but a lot of the kind of initial fear after the war in Ukraine, it has subsided. The other thing, when you look at the economy, and this is a leading economic indicator index, and what it does is, you can see it goes back to 1970, and the shaded bars here are examples of where we had recessions, and the orange is where the economy was shrinking, right? It was in a contraction phase. And so what you can see here is that the economy, while it has slowed down, okay, it is still expanding. And the other thing is that there's a huge amount of speculation about the recession that's coming, and how bad it's going to be, and when it's going to arrive, and how long it's going to last. But as you can see here, there is a lot of dispersion in terms of the depth of what recession can look like, and the rate, how deep it is and how long it lasts. And 2020 was extremely deep, but it did not last long. The financial crisis was both very deep and prolonged, okay? But you have other examples like the tech bubble, where it was, somewhat deep, but not as long in duration. And so we don't know. But the bottom line is, the economy is still growing, right, as of right now. And if you listen to some of the second quarter earnings calls with companies, whether it's Union Pacific or Texas Instruments, yes, Prologis is another one I think that was really interesting, where the CEO of Prologis, who also was the founder of the company, Amazon is their biggest client, so they build these big warehouses and then lease out the space to industrial companies. What they're saying is, the expectations that investors have about what's happening in the industry and what they're actually seeing from their own proprietary data do not match. Okay, they are still seeing vacancies remain very low and economic activity remaining strong. Could that change? Of course it could, right? But investors are so focused on everything that could go wrong, because it feels like everything's going wrong, that they're in part, I think, losing sight of the fundamentals. So I think we just need to come back to, yes, clearly the economy is slowing, but it is still growing, just at a slower pace. The other thing that's happened is we've had a really big contraction in multiples. And what that means is this is a measure over time of how expensive the market is. And it's just one metric, but it looks at, it's called the forward PE. And what that means is, it's how much are investors willing to pay for the next 12 months of earnings, right? If they're willing to pay more for the next 12 months of earnings, like during the tech bubble, they have a lot of optimism about the future, okay? And we saw that really, you see this rapid decline and then rise, and then it's sustained, where we had all of the COVID buying that was taking place. Interest rates were at zero. The Fed was saying they weren't going to raise rates till 23. There's a lot of fiscal stimulus, a lot of optimism, right? But all of that optimism has now come off the table. And so the current forward PE ratio is roughly 16 times. Okay, so investors are willing to pay 16 times $1 of next year's earnings. That's what that means. But look, historically, we're right in line with the long-term average of 15.5. So we're not overly, it's not like financial crisis levels, but we're also no longer at the frothy levels we were earlier this year, or where it was in the late 90s. Okay, so, and look how fast the drop off was. So the silver lining here is, one, valuations have come down a lot and earnings still haven't yet come down. They could, right? That's kind of what the market is expecting, but it doesn't know how much they're going to come down. And the other thing is that what has changed is that during the last decade, if you recall, anytime there was any whiff of financial trouble, economic trouble, the Federal Reserve would lower interest rates or do some quantitative easing. That's gone now. So that was called the Fed put, and that's largely gone. And that, we think, is actually a healthy thing, because what future stock returns are going to be based on are fundamentals, right? Earnings growth, right? Companies growing their businesses versus the stock returns getting bigger or going up because the Federal Reserve is lowering interest rates, right? Artificially keeping rates low so that, right, people would pay more, people would kind of be forced to move into stocks. So what this could give rise to, the silver lining, is a much more sustained expansion rather than this boom bust cycle we saw over the last 2 years. And the other thing, this dovetails directly with that valuation chart we just looked at, is this looks at the S&P forward PE and subsequent annualized returns since 1985. So all these data points, right, go back to or calendar years from 1985. And then you have, what I really want you to focus on here is the blue diamond, which are forward 10-year annualized returns. So you can see down here, the more expensive or the higher the price to earnings ratio, the general trend here is lower long-term returns. And the cheaper the price to earnings ratio, the higher the forward year returns. So where we are right now is on this dotted line, okay? And this is just historical, so we don't know exactly how it's going to play out in the future, but you can see here that the 10-year forward returns, when you're in this kind of 15 to 17 range, aren't that bad, right? Historically, you've been to mid-high single-digit returns for stocks, which frankly would be pretty attractive, I think. A lot of people would take that going forward right now. And this is also a reason why it's so hard for investors to do this, but right, when there's more optimism, right, more excitement about the money that people have made, they pile into stocks when stocks are more expensive. And when their stocks are more expensive, on average, over a long time frame, what happens, right? The long-term return is lower. Whereas when there's more fear in the market, right, when valuations are lower, it actually results in higher long-term returns historically. So remember that you want to try to be kind of on the other side, on the margin. You want to keep your overall allocation, intact based on your long-term goals. But on the margin, when there's more fear in the markets, okay, when investor sentiment is lower, you actually want to try to lean in. And the reason is because probabilistically, long-term, that's when your better returns are going to come. So another example of silver lining is that there are quality businesses, stocks of quality businesses that may be on sale if we can look out more than 6 to 12 months, right? If we can look out 3 to 5 years, this is just an example. It's not at all to say go out and buy this, right? As I mentioned in the disclaimer, but it just wanted to show you an example. Very simple example of a company called Texas Instruments, which makes analog semiconductor chips. This is the price of the stock going back 5 years, okay? And this, on the bottom, this blue line, is how much investors are willing to pay for $1 of forward earnings. And so what you can see here is that after COVID, during COVID, valuations really peaked, right, and stayed elevated, but then gradually over the last year and a half, they've come all the way down to, if you look over 5 years, a little bit less than the 5-year average, right? So you've had a big multiple contraction. Now the stock has actually continued to do pretty well. Why? Because they've continued to grow earnings. They've continued to grow earnings. It's just that investors are not willing to pay as much because there's more pessimism. So you're seeing companies that are of really high quality, in our opinion, really strong balance sheet, like Texas Instruments, where not much has changed in the fundamentals, right? Very little, but investors are not willing to pay as much because of all the macroeconomic concerns. So it's an example of something where there's companies that are now emerging where they really are, in our opinion, on sale if you look at over a long-term basis. Another one, you know, we talk about a lot, Berkshire Hathaway. You can see here, Berkshire Hathaway really lagged the market for all of 2020. You know, it went down during COVID, it kind of stayed down and came back some, but, you know, the market was up, you know, 15, 20% in 2020. Berkshire was basically flat. But then after that, in 21, Berkshire really started to gain. And up until March of this year, it was, you know, flying high, and now it's even come down. That's the stock price. But look at how investors' expectations have changed. It was kind of very low, elevated through here, stayed elevated, but just in the last, this is 3 to 4 months. Look how much excess has come off to where you're now at levels, you know, that going back to 2019 and 18. So again, something to be aware of, that, you know, what's really materially changed in the fundamentals, and then what are investors, you know, willing to pay. And there's a lot more pessimism baked in over a very short time frame, I might add, to a company that's, you know, obviously been around since 1965. It's a conglomerate of, you know, almost 100 operating companies, very well diversified. So just another example, I think, of quality businesses, stocks quality businesses that are on sale, that may be on sale. The other thing, and we've talked about this a lot with clients year to date, is bonds really have not been a good risk mitigator if we look back from January 1st to today. However, if you look a little more granularly, they actually have returned as they've resumed their role as a risk mitigator over the last 3 months. And that's important because that means that interest rates have stabilized and that people are starting again to look at bonds, to purchase bonds as a way to offset some of the risk from the sell-off in stocks. So you can see here in the last 3 months, this is the Dow, the NASDAQ, and the S&P down, you know, 8 to 10%. But you can see government bonds are actually positive over that time frame, 0.31%. So, you know, again, this is a silver lining presentation, and the idea that over the last 3 months, fixed income has buffered you a lot from some of the declines in stocks, we think is a very positive sign. Bear markets and recoveries. This is going back all the way to World War II, okay? So bear markets are peak to trough declines of 20% or more. We're still in a bear market here. We've been in a bear market since the end of the year. Parts of the market, you could argue, have been in a bear market since the fall of last year, particularly technology. But the point here is that we are well into the bear market, and bear markets historically do not last forever, right? And in fact, the average recovery time is 2 years. So I'm not saying that that's nothing. I'm not saying that would be painful, but what we are saying is the reason we do financial planning and we build the plan is we build in a buffer, right, of, you know, the market not coming back for 5, 7, 10 years, okay? But the reality is, historically, the average bear market has recovered in a 2-year time frame. So something to keep in mind is that, right, nothing stays the same forever. Things change, sentiment shifts. Right now, we're in a period of a lot of pessimism, but the silver lining is that we do not think that will last forever, okay? And there are things you can do now to take advantage of it, to position yourself well, looking out 3 to 5 years. Another silver lining, this is a contrarian indicator. It's called investor sentiment. And what it looks at is essentially how bearish or negative are investors. Because historically, the more bearish and negative investors are, the better the forward returns, and the more bullish that investors are, right, the more optimistic, the lower the forward returns. And you can see here, we are at levels right now, really, and if you look at consumer sentiment, we're at levels that we haven't seen since 2011 or 2008. So there is a lot of negativity in the markets already. A lot has been priced in, okay? So you have to keep that in mind, is that the market is always forward looking, right? It's anticipating the future. And a lot of times it wants to get ahead of the actual bad news that it thinks is going to happen. And so keep in mind that when sentiment gets overly negative, you can have, you know, a significant rally even in a bear market. Corporate bond yields, right? This is kind of going back to the yield story I was talking about earlier, where whether it's at the highest, you know, AAA, which is, you know, very, very pristine balance sheet, very low debt service ratio, all the way up to the kind of the lowest quality companies. You know, I'll just focus here on the higher quality, you know, AAA, BBB. You can see, right, the yields you're getting now on those fixed income securities, looking back, you know, over the last 7-8 years, is at the almost the highest levels, if not the highest levels over that time frame. For AAA, it is at the highest levels. So you can now generate, in our opinion, material yield without really having to sacrifice in quality. And that's a definite silver lining of this market. Economic activity, manufacturing activity, the way to look at this, it's called the ISM index. If it's greater than 50, it means that it represents economic expansion. Less than 50 represents economic contraction. And so again, it has come down, but it is still at healthy levels in the mid 50s. Okay, so it is still above 50. Okay, and there have been times you can see here in late 15, early 16, and then late 13, early 14, where it dipped right into contraction territory, but came back, right? And it dipped again and came back. And there's other times like 2008 and 9, where it really dipped into negative territory and stayed there for a while. And then in 2020, it dipped into negative territory and was pretty sharp, and then rebounded sharply. So jury is still out where we're going in the future. But as of right now, not what's going to happen, but as of right now, the economy is slowing, but still expanding. The other, I think, silver lining that gets lost is employment remains very strong, right? Unemployment is at historic lows, right? And even underemployment, which you know, has been an issue, a real issue over the last decade because of, you know, stagnation and just people being kind of underemployed. That's also at an all-time low. So jobs remain plentiful. The job market remains strong. Households, right? Household net worth is still at a peak, even amidst the most recent bear market, and well above the prior peak before the last big bear market at 70, you know, it's at 150 trillion. In 2007 at the peak, it was at 71 trillion. So people are overall much wealthier than they were last 3 years, 5 years, 10 years, 15 years. And the consumer, in terms of their debt service, remains very strong. So debt service is as a percentage of income. Household debt service includes consumer and mortgage debt, and it remains at 9.5% of income, which, looking back to 1990, is the, you know, other than these kind of strange period going into the pandemic, is the strongest it's been. And a big reason for that is that a lot of people refinance their mortgages. Those who were taking out mortgages, right, were be able to do so at very, very low rates. So that's the consumer remains strong. The consumer's balance sheet remains strong. And another silver lining is that corporations are in much better shape now than they were going into the financial crisis, right? They also have used the last 10 to 15 years to refinance their debt, to lock in debt over long time frames at low rates. And so the debt to equity ratio of whether it's large, mid, or small remains strong. It remains very strong relative to where it was, you know, previously. So I think that's another big thing. The consumer is strong, corporations are strong in terms of their balance sheet strength. So this, you can see, this is housing prices. Okay, so the S&P Case-Shiller Index, it measures, national housing prices looks at the 20 biggest cities. And you can see the massive decline during the housing bubble and the global financial crisis, where it really almost got cut in half. And then it took quite a while, much longer than the stock market took to recover. It took about to the 2018-19 level before it eclipsed that high. And then during COVID, it's really just gone up. So it's easy and to focus and natural to focus on the negatives of financial assets, stocks and bonds going down year to date. But this, there is a silver lining in that people's houses have gone up and stayed up so far. And so people have a lot more equity in their homes. And that has helped overall, when you look at the net worth, to offset some of the paper losses in their investments. Where this goes with higher mortgage rates, we will see. But as of right now, housing has slowed, but still prices have, because of low inventory, prices have remained strong. This is looking at, over the last 24 months, currency prices relative to other currencies. And this dark blue here, you can see, is the US dollar, which a lot of volatility, obviously, during COVID, but the dollar has strengthened in value dramatically across every other major currency, whether it's the euro, the Japanese yen, or the pound. It has strengthened. And so the positive here, the silver lining, is that a lot of our clients and a lot of people haven't traveled for the last 2 years. And so to the extent you're finally now traveling and you're going abroad, the dollar is going to go a lot further for that trip than it has previously. So, for a lot of our clients who are now traveling again, that's a nice silver lining, that the dollar is at an all-time high. Okay, this is a little more technical. It's called the TED spread, but the important thing to remember is it's a measure of the stress in the financial system. Okay, and this is something that the Fed definitely keeps an eye on. And while there's been a huge amount of liquidity that's been drawn out of the system, right, because of increases in rates, less fiscal stimulus, right, there's been a lot of selling that's occurred, stocks and bonds. But what hasn't been disrupted is the overall financial plumbing, right? Banks remain very strong. And so the TED spread, which is a measure of, stress in the financial system, continues to remain very, very low relative to the average. And you wouldn't even know that we were in a bear market, frankly, because if you look at these other periods of crises, right, the TED spread can be very volatile and significantly elevated. We saw it in 2008 during the liquidity crisis, right? And this was look, you could see here, there were issues. I think this was Bear Stearns collapse, but even well before the recession, there was a lot of signs of financial stress. Banks were not as well capitalized, and they were kind of leading us into the recession. And then in 2020, again, during the height of the fear at the beginning of the pandemic, people got scared, right? People got scared. They were worried they weren't going to be able to get money out of their banks. And so again, it spiked. But right now, despite the selling, things have been orderly and the plumbing remains strong. Industrial production and capacity utilization, right? Both indicators of economic activity also continue to remain strong, right? So you can see here both capacity utilization and industrial production, both at healthy levels. And then lastly, silver lining with COVID, we know that there's another variant out there and a lot of people are getting sick, but one of the positives here is the red line, which is, you can see the flat line of the number of people who have passed as a result of COVID. So it's a tragic circumstance, and we saw huge surge in deaths at the beginning, but over time, what you see is really not nearly as many people are passing away. So we really had a flat line on the number of deaths, which I think is a positive, all things considered. So that is the end of the presentation that we wanted to cover. So let's go ahead and move to Q&A. And so if you want to put your question in the Q&A box at the bottom of your screen, Jeff and I will do our best to answer those questions. And if we don't know the answer, we'll make sure we get back to you. Okay, so one question we have that came in is about the inversion of the yield curve, which is a fair question, which is basically when the short end, the 1 year, 2 year, 5 year part of the yield curve is actually higher than the longer term part of the yield curve. So like the 10 year and the 20 year. And that is talked a lot about as a sign of, you know, a recession coming. So Jeff, do you want to talk for a second about that? Hopefully all your tech is working over there.
Yeah, sure. I can answer that. So right, like Josh said, definitionally, the yield curve inversion is something that happens when the Fed is essentially hiking rates on the low end. So think about the yield that you receive in your bank account, on your savings account, that sort of thing. And those type of rates are influenced by what the Fed is doing. So that's monetary policy. The longer out you go, so 5, 7, 10, 15 years, those bonds that we see, those yields that we see in the bond market are kind of influenced less by monetary policy and more by kind of growth expectations. So what's happening when the yield curve inverts is the Fed is raising interest rates on the short end, think 0 to 3 months. But then growth expectations are also moving kind of in response to that. And so the inversion happens when the Fed has hiked interest rates higher over the short term than what longer term growth rate really of the economy is going to be. And then the idea or the argument is really that that kind of assumes a recession is coming. And we have seen that. I mean, there's a long history of data that shows, you know, when the 2-year treasury yield gets above the 10-year treasury yield, a recession ultimately ensues. And so, you know, I think it's something to kind of consider. You know, one of the responses is that it doesn't always work exactly like that. And even if it does, inevitably, you know, sometimes it kind of signifies a slowdown in the economy, you know, 1 to 2 years out. And if you think back to, you know, 2018, I think was the last time the curve inverted. 2019 was a fantastic year for the equity market. So if you used it essentially as a timing tool, kind of get in and out of stocks, you kind of would have missed a pretty good year in the market. Of course, 2020, COVID happened, but, you know, a lot of people kind of forget the first couple months of 2020 were actually pretty decent. COVID hit, took the market down, and then, you know, ultimately 2020 ended up being a decent year for the market too. So, you know, I would caution people about kind of using the yield curve inversion as a timing tool to kind of position things in and out of stocks.
That's great. Next question, I think, is a good one. I'm going to go back. It's saying, the question is about here, net household net worth. And the question was basically, this is in aggregate, the household net worth has increased a lot, but how much of that is driven by kind of a smaller sliver of the population accumulating more and more of the wealth? And we don't know exactly, if you tease this apart, how much of that, but there's no question that I think that trend is true, right? Because you have a very small number of people that have such massive net worths that's certainly pulling this number up. I mean, a good example is if you're in a classroom, a lecture hall of people, and Bill Gates walks in, the average net worth, right, that is going to increase dramatically, but the median net worth wouldn't move at all. And so that is definitely a part of this. But still, I think when you look across the board, I think the trend has still been up and to the right, but not probably as dramatic as this is showing. So that's a good question. Oh wow, nice compliment. Best presentation ever from any source. That's a big compliment, but thank you. So I mean, yeah, the point of the presentation is to provide some balance, right? Because again, like we said when we started, all you have to do is turn on the news or look at a newspaper or go to the gas station, and you're going to see a ton of negativity out there. But investing and being a good long-term investor is, I think, as much about looking at the situation that's in front of you as it currently is, rather than kind of what you want it to be, or what people are saying it is, and then making good trade-offs in terms of the risk reward, right? And that's what we try to do. That's what we seek out in the managers that we use for mutual funds that we invest in. And that's in times like this, actually, it's those managers can really shine, right? Because they can identify some of the stocks that we kind of talked about, where if you look out 3 years, the risk reward can be really compelling. So it's these times where actually you want to be extra patient and maybe even lean in a little bit, depending on your overall circumstances and risk tolerance, because these are when you get the opportunities. Okay, so sorry, I'm just reading, there's more questions. So the president says we are not in recession. How confident are you in the president's current assessment of our near-term economic situation, and how does this assessment or misinterpretation affect the market? We didn't include the slide here, but there's actually, I don't know, Jeff, if you have anything handy that we can pull up, but there is a slide that kind of shows whether there's a Republican or Democrat in office, and you look back in history. I have no doubt that the current administration has some effect on the economy and in the markets. The only thing I would say as an example of where you want to be careful of that is, I remember when Trump was elected and he was very kind of vocal and against big tech, particularly Amazon, and a lot of that sector kind of sold off at the beginning of his term, but it actually ended up being one of the best sectors to own throughout his term. So it's really, really hard to predict. It's really, really, really hard to predict that based on the administration or where they're leaning, what effect that's going to have on the market. We really just try to focus on the fundamentals of companies. I think when everyone, actually one of the managers that we follow closely, I think said it well, which is when everyone is focused on the macroeconomic picture and obsessed with what's going to happen with inflation, are we going to go into a recession, where interest rates going to end up, they lose sight of the fundamentals at a company level. And what drives stock returns over the long term is earnings per share growth, right? That's it. And there's always going to be volatility in the macroeconomic picture. It happens to be heightened right now, but it doesn't change how companies are operating and what they're planning for over the next 3, 5, and 10 years. Texas Instruments, as an example, was investing about $750 million in CapEx leading up to 2022, and starting in I think maybe they started in 2021, they're now investing $2.5 billion. So clearly they're planning and looking out the next 15 years to drive long-term shareholder return. So I'm not trying to avoid the question. I don't know if the president is right. You know, but we're certainly, there are concerns about the recession. Everyone's talking about it. We do not see that it is happening yet. But clearly, we could be going there. We haven't had a recession other than COVID in a long time. So, but it doesn't change how we're looking at our investment, in the investment process we're using.
I would just add on that, you know, the outfit that really dates recessionary periods in the US is a private enterprise called NBER, the National Bureau of Economic Research. And they're, again, it's non-governmental and kind of does these things independently. And what they're looking at is kind of you know, the depth of the economic contraction, how widespread is it? So if it's only in manufacturing or only in chemicals or only in a specific sector, obviously that's not widespread enough to cause a recession. And then it's kind of how long does it go on for? So COVID was very sharp decline you saw on that chart and ultimately fulfilled the definition of a technical recession, but we know that it happened very quickly. And then, you know, stimulus kind of brought us back out of that very quickly as well. So what I would say is that, you know, one of the things NBER looks at are, you know, employment. Josh showed that unemployment rate was still pretty low. Economic indicators are still positive. They're declining or slowing, but they're not negative yet. So I don't really think when we're looking back at this period exactly, it will show that we're in a recession. Whether or not we get there in the next 3 to 6 months, of course, remains to be seen. But I think when you're kind of looking at a series of kind of coincident indicators, employment, manufacturing capacity and utilization, all of those things which we kind of showed graphically earlier in the presentation, I think it kind of still shows that we're above water.
That's great, Jeff. Thank you. Any other questions? We're so happy that this webinar turned out to have a big turnout, and we worked really hard on it. It's not easy to find the silver linings when everyone's focused on the negatives, but hopefully you got something from this. And if you have follow-up questions, you can email us. Pretty easy. Josh at 4J Wealth, Jeff at 4J Wealth, info at 4J Wealth, and one of the J's will get it and we'll get back to you. So we will see you next month. And you know, thank you again for attending. We really do appreciate it, and we appreciate the support. So take care.